Tuesday, May 28th, 2019, Maneco 64, home of alternative economics and contrarian views. This morning I want to talk about inflation and how the real rate of inflation has been running well over 4% in the United States over the last 3 years. And to do that, I'm going to first look at the definition of inflation back in the 70s and how they've corrupted that word, and how economists, central bankers, are actually not being honest with the public for the last 25 years or even more. And that's why the crises keep getting bigger and bigger, because they're inflating more and more, and at the same time saying that there is no inflation. So I'll look at that this morning, and then at the end I'll quickly look at what the markets are doing. So let's start with the inflation. So what's got me to want to talk about this? Well, it's the persistent stories out there, especially in the mainstream media, financial media, coming out of the mouths of Keynesian economists that work for the Wall Street, City of London banks, the economists that work for the central banks, for the BIS, for the IMF. It's all rubbish. All this talk that they've got a problem with inflation, a problem that it's too low. I mean, it's ridiculous. All of us know that the cost of living has been rising massively. I guess these people don't live in the real world. They don't, all their expenses are paid, much like the politicians here in the UK. So they don't care. They don't really follow to see how things are going in the real world. One of the reasons I want to talk about inflation and the true rate of inflation, the true definition of inflation, are articles like this in the FT. It says, what will it take to lift the US inflation? The U.S. Federal Reserve, and I read from the article, the U.S. Federal Reserve is growing jittery about subdued inflation. There was a risk that inflation expectations could become anchored at levels below those consistent with the committee's symmetric 2% objective, warned Fed officials at its most recent policy meeting. Some measures of U.S. inflation remain stubbornly low, despite low unemployment, tariff pressures on prices, and central bank halting interest rate rises. The 10-year break-even rate, a measure of the market's inflation expectations, has now sunk to just 1.8% from a peak of 1.98% earlier this year. Well, you see, these market indicators, they're manipulated by the central banks. So they manipulate the TIPS securities, they manipulate the Treasury securities to make things look, aside from changing the definition of inflation, right? So this is the kind of rubbish we get from the central banks, and I want to expose these people. And I've made several videos about this topic of inflation. So I'm going to go back to the Merriam-Webster dictionary. Back from the 70s. I think it was my dad's. It's in quite, I haven't got the back cover, as you can see. I had to tape the cover on, so it's an old one. But if you go back, if you go to the definition of inflation, which I have here on page 365, it says, the first one is an act of inflating, the state of being inflated. Number 3, this is the important one that we need to look at. An abnormal increase in the volume of money and credit resulting in a substantial and continuing rise in the general price level. So that's what it is. So that's why they've had to change the definition of inflation from the actual definition to the consequence of inflation, which is rising prices. As you can see here, inflation is an increase in the volume of money and credit, or an abnormal increase, right? So what have we had in the last 11 years? We have had an abnormal increase in the amount of money and credit. I mean, no one can deny that. And that's inflation. But the CPI that they use is a measure of prices, which they have manipulated, as we all know, through shadowstats.com. Highly recommend that. John Williams, Shadow Stats. He shows how if the statisticians from the government calculated CPI like they did back in the 90s or the 80s, we'd have 5 or even more percent CPI. But they've been quite crafty. What they've done is that they've changed the definition. The other thing that I want to cover today is money supply, because that's the broadest measure of money and credit, right? Money supply growth. I remember back in the 90s, we used to follow M3, and then the Fed actually discontinued publishing M3, even though it still follows it. So let's have a look at what M3 is. It says here in Investopedia, M3 is a measure of the money supply that includes M2 as well as large time deposits, institutional money market funds, short-term repurchase agreements, which are repos, and larger liquid assets. So that's M3. And it says here, calculating M3, the Federal Reserve in M3. So since 2006, M3 is no longer tracked by the U.S. Central Bank, the Federal Reserve. The Fed did not use M3 in its monetary policy decisions even before 2006. So you can see that they're trying to get the public and investors and the economists away from looking at M3. They still look at M2 and publish it, but M3 is a lot broader, and it would show the real rate of inflation, the abnormal increase in the volume of money and credit. So I've got here from thebalance.com, money supply and how it affects you. This is from February 2019, and they've got here the M2 growth, which is really inflation. They've been brainwashed into thinking that they've got another measure for inflation, which is the CPI, right? And that's totally bogus. You can see here, 1990, we had M2 growth or real inflation at 3.7%. We had the CPI at 6.1. And you can see here that M2 growth has been like quite high, except for 1994 when it was 0.4%. But you look at it, it's been over 2%. It's been near 10%. Let's see what it's been in the last 3 years. 2016, 7.4%. 2017, 4.9%. 2018, 5.1%. So you can see that it doesn't add up, that their inflation, their CPI is like around 2%, even though money supply growth, M2, which isn't even the broadest measure, is running, over, well, basically over 5%. If you look at since 2008, the lowest it's ever run is 3.6% back in 2010. So with that, I've looked at M3. You might say, well, the Federal Reserve doesn't publish M3 anymore. Well, but it does. The St. Louis Fed does. And I've got their data here. So, and I've looked at M3, which is, I would say, one of the broadest measures of real inflation. And I've done the calculations here from the Federal Reserve Bank of St. Louis's data. And I've worked out that from 2016 to 2017, M3 grew at 6.58%. So it increased from 12,461 billion or 12.461 trillion to 13,282 billion. So that was 6.58% for 16-17. 17-18, you can see here increased from 13.28 trillion to 13.86. That's 4.4. And in the latest year, from 2018, January 2018 to January 2019, it increased by 4.1%, from 13.86 trillion to 14.438 trillion. You might say, oh, it doesn't matter because they don't look at money supply anymore. It's not important. It's not translating into their inflation or CPI. I would say that's rubbish. And that's why the general public is feeling the increase in the cost of living, because there is an excess creation of money and credit, abnormal creation of money and credit out there. I even remember back in the 90s, the Bundesbank, which was, was at the time known for being a very strict, hard money central bank. The only data that we followed that was the most important number for the bond markets was M3, German M3. That was a huge number. If that number came over like 3%, the bond markets would sell off massively. The Bunds yields would go up because it would show that the Bundesbank was going to be tight on money because they didn't want to see M3 over 3%. But of course, we've forgotten about this, and now we get such articles as we got in the FT, this kind of rubbish. So it's 7:42 a.m. I'm going to quickly go through what the markets are doing. Right now, spot gold is at $1283.80, down $1.20. The range has been $1282 to $1290. Actually, we got up to 90 overnight. Silver is $1454, down about 4. Range has been $1452 to $1462. The Dow futures at 25,660, which compared to the close on Friday is up about 75 points. I've got it here up 17, but I think the IG index is calculated off the close, the futures close yesterday. So we're up about 75 points. The S&P is at 2833. So let's see where we are. We're up about 7 points in the S&P, and the NASDAQ 100 future is at 73.25. That's up about 20 points. So yeah, stock market is a little firmer this morning. The currencies are very steady. I won't go over them really. The pound is just the pound, which is up a little bit, 0.1%, but still below 127. So yeah, currencies pretty much unchanged. Crude oil is 59.01, down about 20 cents, and Brent crude is 68.69, down about 10. By crude oil at 59, I meant the WTI. What about the bond markets to finish off? Well, actually, yields are actually continuing to drop here, which seems a bit counterintuitive with the stock market being up. The 10-year yield is down 2.5 basis points at 230, while the 1 month is at 236.5. So 6 basis points inversion there of the yield curve. Don't let the central bankers, nor the mainstream economists, nor mainstream publications, financial publications, fool you about inflation. If we do have deflation, it will be a deflation of paper assets and financial assets. But we've already had a massive amount of inflation, and we're still having a massive amount of inflation. You know, how can the Fed really say that they're concerned about inflation when M3 is growing at least 4% for the last 3 years? If you enjoyed this video, make sure you share it far and wide. Make sure you also hit the like button. Make sure you subscribe to my channel if you haven't yet. And you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.